Hello everybody, it's Ryan Schramm. Happy New Year to all my clients, friends, and family. We're coming to you live from our office today with a quick video. Something we're going to be doing a whole lot more of in 2018 is sending you guys content via video that applies to you. If you have anything you guys want me to discuss, we'd love to hear from you. Email us, text us, and tell us what you'd like us to talk about. Today, we wanted to discuss the passing of the President's new tax cuts and dissect a few of the provisions that are going to directly affect the real estate market and you as a homeowner or future buyer. So there's still a great amount of confusion circulating regarding the tax reform, and I'm here to answer any questions you have. But first, a quick disclaimer. This video is not intended to provide personal tax advice, but it's just a discussion on how the new tax code could potentially impact buyers and sellers in your marketplace. So as always, for personal tax tips, please be sure to contact your CPA. So, moving forward in an effort to keep it simple, there are three key elements or takeaways of the tax reform that we're going to be analyzing today. I've got them up here on the board for us. They're the big three: what's been proposed and what's been finalized, and I'm going to take you guys through it. Takeaway number one, probably the most talked about change, is the mortgage interest rate deduction. We all know that one of the great things about home ownership is being able to deduct the interest on our mortgage from our taxes. Well, we can still do that. The previous law allowed for mortgage interest deduction of up to $1 million, and the new law is going to allow up to $750,000 of your mortgage interest to be deducted. So if you close the loan on or before December 15th, 2017, don't worry, nothing changes for you. The mortgage is grandfathered in. We can still continue to deduct up to $1 million of mortgage interest. So how is this new tax law going to affect the market? Honestly, it's really only going to affect a small percentage of buyers that are purchasing between the range of $900,000 and $1.25 million. And even for those buyers in that price range, if you're currently looking at a home with me in that price range, it really means that you're not going to be able to shield a couple $100s a month of tax. And the way that our market's currently appreciating at 5 to 7% per year, you're really not going to even feel that with the gains you've made on appreciation. So takeaway number two, it has to do with the tax exemption on capital gains. This was a hot topic of discussion before the year. A lot of people were wondering how this was going to play out. A quick backstory for you guys on how the capital gain exemption works. If you own and live in a residence for 2 out of 5 years leading up to the sale of that home, up to $250,000 of profit from the sale is tax-free. So you pay no money, you pay no taxes on that profit. If you're married and you file a joint return, the tax-free amount doubles up to $500,000. So it's a huge advantage of filing that joint return. If you profit at all and it exceeds those limits, the excess gain has to be reported as capital gains on your taxes. And the capital gains tax, as we all know, it's a really steep percentage. So it's always nice to avoid paying those capital gains. And that's what made everyone concerned, was that the government was proposing to change this law and make it so that you would have to live there a whole 5 years out of 8 years in order to benefit from any of the deductions. Luckily, they kept the bill exactly the same, no changes were made, and the old law still applies, so that's great news. Major takeaway number three, and this is going to be my last one for you here, it has to do with SALT. You probably have heard the term, but if you don't know what the SALT is, put simply, state and local tax deduction. It allows taxpayers who itemize their tax deductions to deduct state and local property tax and state income tax, sales tax, and you put that on your federal return as a deduction, and it was an unlimited amount. Our previous law was unlimited. So we do have a change on this new law which was passed, and in effect it's going to go ahead and cap the SALT tax at $10,000. So big change there. Those of you who make between $200,000 and $500,000 a year, you're going to want to sit down with your CPA and ask them how you can strategize. So big picture, what is this going to do and how is this going to affect the market? in the high tax states, we're going to have a lot of retirees who will consider moving to lower tax states. So with the high tax states only having up to $10,000 to deduct, many more may move to the lower tax states, which would ultimately ramp up the inventory in the high tax states. If this happens and the change creates an exodus to the tax-friendly states, that inventory is going to be gobbled up by the buyer demand anyways. So it really wouldn't be such a bad thing if there was more houses to choose from in Southern California, San Francisco, and New York anyways. So in conclusion, bottom line, there's a lot of negativity still out there surrounding the tax structure, but those in the know, the chief economists that we subscribe to, the industry leaders, they're all telling us to stay calm. That the demand for housing is so great right now. It's at such a high point, this tax reform bill couldn't stop it if it tried. And furthermore, the belief in homeownership and the American dream and that road to financial freedom is still extremely strong. So, short story, the sky is not falling. If you guys have any more questions on that, feel free to call or email. If you've had any questions about buying or selling, reach out to me. And furthermore, if you've got anyone who you think could benefit from our local market knowledge and any advice in real estate, shoot me their number and I'll get back to them right away. As always, thank you guys so much for being a part of my life and my business. We look forward to seeing you soon.